We told you the supply was stopping in Peru. We told you China was closing the door. And now the consequences have officially arrived in London. Breaking data from the wholesale market shows that silver lease rates in London have just undergone one of the most violent spikes in modern financial history. For those who don't know, the lease rate is the interest rate banks pay to borrow silver from each other. When there is plenty of silver, this rate hovers near zero, sometimes even negative. But in October 2025, it hit 35% per annum. That's not a typo, 35%. This is the heartbeat of the silver market. And right now, the patient is coding. The metal isn't there. The fifth year of deficit has finally drained the system. London, the global hub where silver prices are set, where trillion-dollar trades clear, is running on fumes. And when the hub goes empty, the price goes to infinity. Let me explain what a lease rate actually means, because this is where the story begins. In the London bullion market, banks don't just trade silver, they lease it to each other. Think of it like borrowing a car for the weekend. If cars are plentiful, the rental fee is cheap. But if there's only one car left in the entire city and 10 people need it desperately, that rental price explodes. That's what happened in October 2025, according to data compiled by Bullion Vault and confirmed by multiple market sources. Silver's 1-month lease rate reached 19% per annum in early October, then spiked again to 35% as silver prices touched new all-time highs above $50 per ounce. Why would a bank pay 35% annual interest to borrow a bar of silver for just 1 month? Because they sold silver they didn't have. They wrote a contract, a short position, promising to deliver physical metal to a buyer. But when the delivery date arrived, they couldn't find the metal, so they had to borrow it at any price. This is called a short squeeze, and it's a sign of absolute desperation. But to truly understand why this squeeze is fatal, you have to understand the dirty little secret of the London market. It's called unallocated accounts. When most institutions buy silver in London, they don't buy a specific bar with a serial number sitting on a specific shelf. They buy a claim. They buy a line item on a ledger that says the bank owes them silver. The bank takes that money and uses it. They might keep a fraction of the physical metal on hand, maybe 10%, maybe less, betting that not everyone will ask for delivery at the same time. In the banking world, this is called fractional reserve banking. In the precious metals world, it's a game of musical chairs played with dynamite. For decades, for every 1 ounce of physical silver in the vault, there have been 10, 50, sometimes 100 paper ounces traded and sold. This is the paper multiplier. It suppresses the price because it creates the illusion of infinite supply. If you can print a silver contract out of thin air, you can sell it to crush a rally. But here is the mechanism of the collapse we are seeing right now. The lease rate spike proves the paper multiplier has broken. Why? Because industrial buyers, Samsung, Tesla, Foxconn, cannot build circuit boards with paper contracts. They cannot put a claim on silver into a solar panel. They need the physical element Ag, atomic number 47. When those industrial giants demanded delivery in October, the banks looked at their fractional reserves and realized the math didn't work. The music stopped. The 100 paper claims suddenly rushed toward the 1 real ounce. This is why the lease rates exploded. It wasn't just a shortage, it was a run on the bank, a run on the physical vaults of London. The paper silver market is being cannibalized by the physical silver reality. And once that trust is broken, it never returns. No one wants a paper claim anymore. They want the metal. Bruce Ikemizu, former Tokyo Precious Metals banking director and current head of the Japan Bullion Market Association, stated in October, "Silver squeeze is on. This is serious." When a 40-year veteran of precious metals banking uses the word serious, you listen. Now, contrast that with normal conditions. In a healthy market, lease rates are around -1%. That means the party lending the silver actually pays a small fee to the borrower because storage costs money and there's so much metal available. But in 2025, we witnessed the 5th spike in lease rates this year alone. September, October, and into December. Each time banks scrambled for metal. Analysts at TD Securities noted that London silver inventories were sitting at approximately 135 million ounces in October, about half of the metal's daily average trading volume. That's the equivalent of running a major airport with half a day's worth of fuel reserves. One disruption, one unexpected surge in demand, and the system seizes. And here's the critical detail. Lease rates are a lagging indicator. By the time they spike, the crisis is already underway. The metal is already gone. So where did the metal go? Let's look at the numbers. According to official data from the London Bullion Market Association, as of November 2025, London vaults held 2,787 tons of silver, valued at $47.1 billion. That sounds like a lot, doesn't it? Almost 1 billion ounces. But here's the context you're not being told. That same vault system held 35,667 tons at the COVID-era peak in April 2020. We're down almost 50% in 5 years. London has lost nearly 400 million ounces, an entire year of global mine production, from its vaults. Let me say that again. London vaults have lost the equivalent of an entire year's worth of mining output in just 5 years. Where did it go? Solar panels, electric vehicles, data centers, India, China. Industrial demand, that doesn't care about price. When a solar manufacturer needs silver for photovoltaic cells, they buy it. When an EV producer needs silver for circuit boards, they buy it. Price is secondary to production timelines. And here's the catch. Roughly 50% of silver held in London vaults is allocated to ETFs, exchange-traded funds. That metal is technically owned by investors. It's not available for industrial delivery. It's locked. So when analysts say London has 900 million ounces, the float, the metal actually available for trading and delivery, is closer to 450 million ounces. And at current demand levels, that's not enough. In October 2025, something extraordinary happened. According to CPM Group analysis, London vaults received approximately 53.88 million troy ounces of imported silver from New York, Shanghai, and other global locations in a single month. That was the largest monthly inflow in at least 9 years. Why? Because the system was on the verge of collapse. But here's where it gets interesting. Some market observers, including analysts at Silver Trade, have questioned whether that October inflow even happened. They point to rumors that India, which bought over 1,700 tons of silver in October, has not yet received delivery of metal purchased from London vaults. If true, it suggests the LBMA may be misrepresenting inventory levels to calm market fears, something they've been accused of before in May 2021. Whether or not those specific allegations are accurate, the broader point stands. London inventories are at multi-year lows, and the system is straining under demand pressure. Analysts at Metals Focus, presenting at the Silver Institute's annual industry dinner in November 2025, confirmed that 2025 will see the 5th successive deficit, estimated at 95 million ounces. And they added this key detail. The cumulative deficit from 2021 to 2025 totals almost 820 million ounces. That's an entire year of average mine output consumed and not replaced over 5 years. It's been absorbed into solar panels that will last 25 years, into electric vehicles that will run for a decade, into AI data centers that operate 24/7. That silver is functionally gone from the above-ground supply. Let's zoom out and look at the big picture, because this is where the structural case for silver becomes undeniable. According to the Silver Institute's 2025 World Silver Survey, global silver demand in 2025 is projected at 1.20 billion ounces. Total supply from mining and recycling is projected at 1.05 billion ounces. That leaves a deficit of 149 million ounces. That's the 5th consecutive year of deficit. But here's what makes this different from previous commodity cycles. The deficit is not caused by a temporary supply disruption. It's structural. It's driven by green energy mandates, electrification of transportation, and the explosive growth of AI infrastructure. Let me break down the demand side. Industrial fabrication in 2025 is forecast to surpass 700 million ounces for the first time in history. That's a 3% increase year over year, led by photovoltaics and electronics. The solar industry alone consumed 232 million ounces in 2024, and that number is expected to grow despite efforts to reduce silver content per panel through thrifting. Electric vehicles and AI data centers are adding significant new demand. Silver is essential for circuit boards, semiconductors, connectors, and cooling systems. As AI scales globally, data center construction is accelerating, and every data center requires massive amounts of silver for electrical transmission and heat dissipation. Meanwhile, jewelry and silverware demand is declining due to high prices, but investment demand has surged. Exchange-traded product holdings rose by roughly 18% through November 6, 2025, generating a year-to-date increase of 187 million ounces. Investors are piling into silver as a hedge against stagflation, currency debasement, and geopolitical risk. Now let's look at supply. Global mine production in 2025 is expected to reach 844 million ounces, a 7-year high, but still below the 900 million ounce peak from 2016. Why? Because approximately 70 to 80% of silver is a byproduct of other metal mining: lead, zinc, copper, and gold. When base metal prices are suppressed, as they have been, silver production suffers. And here's the structural problem. It takes 10 to 15 years to bring a new silver mine online. You can't just flip a switch and produce more silver in response to higher prices. The supply is inelastic in the short term. Recycling added 200 million ounces in 2025, the highest level since 2012, but even that wasn't enough to close the gap. So here's the math. 1.20 billion ounces of demand minus 1.05 billion ounces of supply equals 149 million ounces of deficit for the 5th year in a row. Where does that deficit come from? Above ground stockpiles, existing inventory, the metal that was sitting in London vaults and COMEX warehouses and Shanghai Futures Exchange depositories, and now those stockpiles are nearly depleted. TD Securities analysts, led by Daniel Gali, warned in October that London's free-floating silver stockpile could be depleted within 4 months if ETF inflows continue at current rates. Even at a slower pace, they estimated less than 7 months of supply remaining. That's not years, that's months. And we're in late December 2025 now. And now, the situation is about to get exponentially worse. On January 1st, 2026, just days from now, China will implement new silver export controls. This is not a rumor. This is official policy announced by China's Ministry of Commerce in late October 2025. Under the new rules, exporters will need government-issued licenses to ship silver abroad. Only large, state-certified companies producing at least 80 tons annually will qualify. Smaller players are excluded. This creates a de facto quota system. Why does this matter? Because China controls 60 to 70% of global silver supply, not just mining, refining. China is the gatekeeper. Even silver mined in Peru or Mexico often goes through Chinese refineries before reaching global markets. In October 2025, China exported over 660 tons of silver, a record. Much of it went to London and New York to temporarily relieve the supply squeeze we just discussed, but that was front-loading. Chinese exporters rushed to deliver metal before the new restrictions took effect and before anticipated U.S. tariffs could be imposed. Starting January 1st, 2026, that flow stops. Analysts estimate the current global silver shortage is approximately 2,500 tons per year. Once China's restrictions take full effect, that shortage could double to more than 5,000 tons annually. Let me put that in perspective. 5,000 tons is 160 million ounces. That's more than an entire year's worth of U.S. mine production. That's the amount of silver consumed by the global solar industry in 8 months. And it's simply not available. China's official rationale is resource conservation and environmental protection. The real reason? Strategic leverage. Silver was added to the U.S. Department of the Interior as list of critical minerals in early November 2025. China sees this and responds by restricting exports, just as it did with rare earth elements, tungsten, and antimony. This is economic warfare through resource control. And here's what's already happening on the ground. Shanghai Futures Exchange inventories fell below 500 tons in November 2025. Record lows. Chinese domestic demand, driven by the booming photovoltaic industry, is absorbing enormous quantities of silver. China is prioritizing its own green energy transition over exports to the West. Meanwhile, India has been aggressively buying physical silver. In October alone, India imported 1,715 tons. Much of this came from Hong Kong, but market observers suspect that Hong Kong is simply routing leased Chinese silver that was originally borrowed from London bullion merchants. In other words, the metal is going in circles, borrowed from London, shipped to Hong Kong, then forwarded to India, while the underlying supply remains constrained. Starting January 1st, even that convoluted supply chain tightens. So, what does all of this mean for price? Let's look at what's already happened and where we're headed. On December 22nd, 2025, yesterday, silver rose to $68.74 per ounce, up 2.39% from the previous day. It's up 33.80% in the past month, and it's up 131.62% compared to the same time last year. That's not speculation, that's scarcity. Earlier this month, on December 9th, silver broke $60 per ounce for the first time since 1980. On December 11th, it touched an intraday high of $64.20. Then on December 18th, it hit $66.20. And on December 23rd, it reached $68.96, a new all-time record. Today, December 23rd, spot silver is trading around $69 per ounce. Gold, for comparison, hit $4,477 per ounce on December 22nd. Also a new all-time record. Gold is up roughly 70% year-to-date, but silver is up 130%. Why? Because silver has both industrial and monetary demand. Gold is primarily a monetary hedge. Silver is consumed. It goes into products that lock it away for decades. And when industrial demand collides with investment demand during a supply shortage, prices explode. Now, let's talk about the gold-silver ratio. Right now, gold is trading at $4,440 per ounce, and silver at $69. That gives us a ratio of roughly 64 to 1, meaning it takes 64 ounces of silver to buy 1 ounce of gold. Historically, the gold-silver ratio averages around 60 to 1 over the long term. During periods of extreme gold outperformance, it can spike to 90 or even 100 to 1. During silver bull markets, it can compress to 40 or even 30 to 1. At the peak of the 2011 silver rally, when silver hit $50, the ratio was around 31 to 1. Here's what the major banks are forecasting for gold. JP Morgan predicts gold will hit $5,055 per ounce by Q4 2026, rising to $5,400 per ounce by the end of 2027. Let's use JP Morgan's forecast as a baseline, $5,055 per ounce by late 2026. If the gold-silver ratio normalizes to 60 to 1, that puts silver at $84 per ounce. If it compresses to 50 to 1, entirely plausible given the supply squeeze, silver reaches $101 per ounce. If we see a full silver mania like 2011, with the ratio dropping to 40 to 1, silver hits $126 per ounce. That's not some pie-in-the-sky prediction. That's basic math based on institutional gold forecasts and historical ratio analysis. And remember, those gold forecasts don't even account for the silver supply crisis we're discussing. They're based on gold fundamentals alone. If silver develops its own supply-driven rally on top of gold's monetary rally, we could see the ratio compressed even further. Some analysts are already calling for triple-digit silver. Keith Neumeyer of First Majestic Silver has stated he sees $100 to $130 per ounce potential. Analysts at Metals Focus, presenting in November, suggested silver could reach $78 per ounce by late 2026, based purely on supply-demand fundamentals. And here's the wild card. If China's export restrictions create an acute physical shortage in the first quarter of 2026, we could see lease rates spike again, this time even higher than October's 35%. If that happens, we're talking about a genuine delivery failure in the London market. Banks unable to deliver metal on contracts, force majeure declarations, cash settlement at artificially inflated prices. That's the scenario that leads to 100 plus to silver in a matter of weeks, not years. Let's talk about what happens if London actually runs dry, because that's the scenario we're approaching. The London Bullion Market Association isn't just a vault system, it's the global clearing mechanism for over-the-counter precious metals trades. Trillions of dollars in notional value flow through London every year. When you see spot silver quoted on financial terminals, that price is set in London. The system works on trust and leverage. Banks trade unallocated silver, meaning you don't own specific bars, you own a claim on silver that exists in an undifferentiated pool. It's efficient, it's liquid. And it works fine as long as there's enough physical metal to satisfy delivery requests. But when the metal isn't there, the system has a problem. In October 2025, we saw a preview of this. Spot silver traded at a premium to near-dated futures, a condition called backwardation. Normally, futures trade at a premium to spot because of storage costs and time value. But when spot is higher than futures, it means people are willing to pay more for immediate delivery than for a promise of future delivery. That's panic buying. The December 2025 COMEX silver contract traded at a discount of up to $1 per ounce compared to London spot prices. Traders were delivering record amounts of silver into COMEX warehouses, not because they wanted to, but because they couldn't get metal out of London. According to reports from Metals Focus and TD Securities, the liquidity squeeze in October was so severe that it required emergency international arbitrage. Metal was rushed from New York, Shanghai, and other locations to stabilize London. But that was a one-time solution. You can't keep draining other markets to prop up London indefinitely. Eventually, those markets run low too. And that's exactly what's happening. COMEX inventories have been drawn down throughout 2025. Shanghai Futures Exchange inventories hit record lows. Even the US Mint and Canada's Royal Mint have reported being out of silver coins and bars at various points this year. So what happens if London actually runs out? First, lease rates would spike to levels we've never seen, 50%, 100% or higher. Banks would be bidding against each other in a desperate scramble for any available metal. Second, the spread between London spot and New York futures would widen dramatically. Arbitrage opportunities would evaporate as physical delivery becomes impossible. Third, we'd see force majeure declarations. Banks would invoke contractual clauses allowing them to settle in cash rather than deliver physical metal. Buyers would receive dollars instead of silver. And here's the key. The cash settlement price would likely be set at an artificial level that does not reflect true market value. Fourth, and this is the end game, the price would go vertical. Because when the official market breaks, trading moves to premium markets, physical dealers, private transactions, buyers paying whatever it takes to secure actual metal. We saw this briefly with palladium in the early 2000s. We saw it with rhodium. And we're watching it unfold now with silver. The London bullion market isn't designed to handle a genuine physical shortage. It's designed for efficiency, not resilience. And right now, we're testing its breaking point. Let me summarize where we are as of December 23rd, 2025. London silver vaults have been drained by 50% over 5 years, losing nearly 400 million ounces. Lease rates spiked to 35% in October as banks scrambled to borrow metal they couldn't find. The global silver market has been in deficit for 5 consecutive years, burning through 820 million ounces of above-ground supply. China is implementing export controls starting January 1st, 2026, 8 days from now, that will cut off 60 to 70% of global refined silver supply. Industrial demand from solar, EVs, and AI continues to accelerate, consuming silver faster than it can be mined. And the price has already surged to 69 per ounce, up 130% in 1 year, with major banks forecasting gold at $5,000 per ounce by late 2026, implying silver could hit $100 or more based on historical ratios. This isn't a speculative bubble. This is a structural supply crisis meeting unstoppable industrial demand. The mines are constrained, the exporters are closing the door, and the hub, London, is running on fumes. When the hub breaks, the price is no longer set by markets. It's set by scarcity, by desperation, by whoever can find the last available ounce. We are watching, in real time, the transition from paper silver to physical silver, from leveraged trading to actual metal, and that transition is violent. If you've been waiting for confirmation, this is it. The data is screaming, the lease rates are screaming, the banks are screaming, London is empty, and the price is going to reflect that reality. Subscribe to this channel, share this video, and prepare for what's coming, because this is no longer a question of if, it's a question of when, and based on everything we've just covered, when is now.